Good afternoon, everyone, and good morning to those of you on the West Coast. This is Josh Willie, and on behalf of the Public Contracting Institute, I'd like to welcome you all to our first GovCon 101 of 2026. Today we are covering accounting essentials, and we are joined by our expert instructor, Adam So. Before we jump in, I do have a few housekeeping announcements. For those of you seeking credit, we will not be providing passwords, but there will be a few polling questions at the conclusion of the slides. Make sure you stay tuned in till the end to complete those polling questions. If you are seeking a certificate, you'll log into your certificate in courses and complete that survey. A copy of the materials can be located under that paperclip icon. And with that, I thank you all for joining. I will hand it to Adam.
Thanks, Josh Willie. So welcome to GovCon 101. We'll be going over the basics, accounting essentials, what you need to know to do work for the government. When you receive a government contract, an award, what are some of the requirements that's needed, to do business as a government contractor. And so with that being said, my name's Adam So. I am a manager at Forvis Mazars. I've been in government compliance my whole career. And so it's been a little bit over 15 years now. How time flies by. The first 10 years of my career I was working in industry at a variety of different government contractors that are located here in Tysons, Virginia. And then, I've been with Forvis Mazars for about 6 years now. And so I help a variety of clients with their government contracting needs. A lot of the things that we'll be going over, help different sizes of clients from small to mid-size and so forth. So today's learning objectives is that, you'll have a high understanding of government contracting. What kind of accounting requirements are needed, what are the expectations for your accounting system. The accounting system, it's one of the areas that a lot of new companies, when they get into government contracting, they might not know the level of effort it's going to require to get your accounting system set up properly. So we'll be going over, some of the details with that. We'll be going over the basics of FAR, specifically Part 31, which talks about, allowability of cost. And so, you should know, what are the requirements, especially when you have government contracts, because each government contract may have their own, specific FAR clauses that's put in there. And so not all government contracts, government awards have the same, FAR regulations. So it's important to know, all the FAR clauses, but specifically the one that applies to your contract. And then we'll be going over cost accounting standards, CAS. And so these are for awards that are higher in dollar threshold. And so if you are lucky to have one of those larger government contracts, what are some of the additional regulations that you'll need to follow as a government contractor? And so, when are accounting requirements necessary? And so within government contracting, you have different contract types. Firm fixed price is essentially what we're used to for those who aren't, who are new to government contracting. This is something that you can walk into a store, and let's say you go to an Apple store and you want to buy an iPhone. They're going to have a price for the iPhone. It doesn't matter how much it costs the company Apple to make the phone, whether it's the materials or the technology, the research and development, there's a set price. And so that's, what we call firm fixed price for government contracting. And then on the other end, on the other side of the spectrum, we have something called cost reimbursable contracts. And so essentially what it is you're going to get reimbursed for your cost, as long as the costs, meets the regulations, and, it's terms of the contract, you're going to get reimbursed for your costs plus an additional, profit percentage on top. And then we have a third type of contract, time and material, T&M. Essentially what it is, it's a hybrid of the two. So the time portion is going to be a fixed price. So let's say you have a labor category of engineer one, and you come to an agreement with the government. You're only going to charge $75 per hour for a labor category engineer one. And most companies, you're going to have many different employees who fit the same labor category. So you might have 10 individuals who are, considered engineer one, who can charge as an engineer one. But we all know, salaries are not equal. For most companies, you might have some that make more than others, some might that make less. But regardless of, how much it costs you, the government contractor, you can only charge $75, the agreed dollar amount, for that labor category. So that's the fixed portion. And then you got something called the materials, which is your non-labor costs. Common material costs associated with T&M contracts would be travel, ODCs, material. And so you're going to get reimbursed at the cost, plus your indirects applied on top. So that's the wide range of, that's the, I guess, the summary of the three contract types. Within government contracting, it's common to have a hybrid. You could have, a cost reimbursable section with a firm fixed price for other, cost elements, what we call CLIN. And then there is all these other, tools that we'll get into. But what are the accounting requirements? Well, if you have a cost reimbursable T&M type of contract, you're going to need an accounting system, and we'll get into detail later. But let's go over the whole marketplace. So the government, from when I started, 2010 to where it currently is, I believe the U.S. government's the #1 employer in the world. If not, they're up there. And so they spend a lot of money. They have a huge budget. As we all know, with the government shutdown, they couldn't come to an agreement. And so, there was a continuing resolution put in place. And right now, the current budget for that is $1 trillion for FY26. And they spend the money in a variety of different places, not just for defense. They also spend it for construction, highway, maintenance and buildings and livestock, R&D, and so forth. So the government, they do spend a lot of money, but it's not just, consolidating to one area. It's, for many different things that essentially is to, benefit, the citizens. And so, who does the government purchase these goods and services from? Well, there is quite of a variety. You got your commercial or for-profit companies. These are companies that, when I think of government contracting, you may think of, the main DoD, contractors like Lockheed, General Dynamics, and so forth. There's like 5 main government contractors out there. But as we all know, there's plenty of small government contractors as well. So there's thousands and thousands of government contractors. And then we have your not-for-profits, universities, state and local governments. And so essentially, who does Uncle Sam buy these goods and services from? It's pretty much everybody who wants to, get into government contracting, as long as they win that award. And so they don't really discriminate on who they purchase from. And so when a government has a need, what they do is they'll, put out an award out there for different companies to bid on. And there's 2 types of procurement methods. There's the price base and the cost base. Price base, when you think of price base, you think of for a fixed price, right? It's going to be a set price. The government, they might need a building, and there might be, government contractor out there that builds buildings, and that's what they do. And they can estimate it's going to cost us X amount of dollars. And they might come to an agreement of, making a building based off of the statement of work that's required within the government contract for $1 million. And so regardless of how much it costs the government contractor, they're only going to get paid that $1 million, right? So it's in the government contractor's, interest to lower the cost, right? The more that they can lower the costs, the more profit margin they'll receive. In some instances for fixed price contracts, they may actually overrun their budget and they actually might be in the red. So the risk is on the government contractor, but with that risk, they typically will, estimate a higher profit margin percentage, right? So, for government contractors who, win for firm fixed price awards, contracts, you want to make sure, hey, you give yourself a little bit more of a wiggle room because the risk is on the government contractor. In recent news, with inflation, that has hurt a lot of government contractors because they didn't really account for that. Before COVID, inflation was probably around 2 to 3% every year, and that was sort of the expectation, moving forward. But for those who've won awards during COVID and didn't account for inflation, well, they more likely than not overran their costs because everything costs more, right? Not just labor, but also material and travel and so forth. And then we go to your cost base, so the other side of the spectrum, which is your cost reimbursable type of work. These awards are typically for goods and services where you're not really sure how much it's going to cost, right? It's undefined. A good example would be research and development, right? Maybe the government wants, the next and brightest, military technology. And because it hasn't been developed yet, you're not really sure how much it's going to cost. So, government, what they do is with these undefined, goods and services that they want, they're probably going to initiate a cost-based contract. And the risk is on the government because, essentially the government contractor would be reimbursed for the cost as long as it fits within the contract terms and regulations. And so the contractor is not, incentivized to keep or maintain their cost down, right? So with this, typically for cost reimbursable contracts, your profit margins are going to be lower than your firm fixed price contracts, which makes sense, right? It's all about who's taking on the risk. The more risk for the government contractor, potentially the higher, profit by the end of the award. And with cost-based contracts, because the risk is on the government's going to have more attention and oversight for the cost base, right? It makes sense. For a price base, we have, we have a few different types of items. One is commerciality, right? What is commerciality? Well, commerciality is saying, hey, this specific good or service is sold to the commercial world, like an iPhone, right? So if the government, let's say, needed, an iPhone, the government contractor wouldn't necessarily need to recreate the wheel and recreate an iPhone. They could just go to Apple and say, hey, we need to order 100 iPhones for this project. And so the good thing about commerciality is there's a set price, and whatever that price is sold to the market, that's how much you can sell it to the government. There's less red tape, less regulations to defend whether the cost is reasonable and so forth. And so commerciality sort of takes away all that government oversight and requirements that you need to follow. A thing about commerciality is there could be variations. It doesn't have to be the exact same good or service. A good example is we had a client who did cleanings for boats, and they would clean all sizes of boats. But then the government, they wanted one of their Navy ships to be cleaned. And although boats and ships different in size, in general, they're pretty similar. So we were able to have our client provide a commercial price for that government contract. And it worked, even though they're not exact identical. Or another example would be, let's say, going back to iPhones, maybe the government wants an iPhone, but have it, with some other technology. As long as it shows that the main item, the main good or service is pretty much similar, you can have variations here and there. And then you have Another thing for price-based competitive bids. If you have competitive bids, what does that mean? It's you have more than one contractor bidding for that award. If you have a competitive bid, you know that for the most part, the government's going to have a favorable price, right? The more competition, typically it means the profit margins go down for the service or good provider. And so, if it's competitively bid, that means, the government, more likely than not, it's going to have a good price. We have something called the federal supply schedules, which, this is similar to like IDIQ, GSA. Essentially what this is you have a set price for certain goods or services. And typically that set price is at a discounted rate. And so what the government realizes, hey, we have purchasing power. As I mentioned before, US government, the probably #1 employer in the world. And so they realize, hey, we can, use this for advantage. And there's all different sorts of agencies out there. We don't know how many need, let's say, a pencil, right? We know that a lot of our agencies use pencils, but we don't know exactly how much this agency needs or that agency needs. But we know that we're going to buy a lot of these materials or goods, pencils. And so, if typically, you sell for $1 a pencil, you might sell it for 80 cents a pencil, because you're going to make your profit not through the profit margin percentage, but through the quantity that you sell. So when I think of this, I think of like the restaurant industry, right? The restaurant industry, the margins are very slim, but they're going to get their profit overall by having as many people come in and order as many times. And then we have sealed bid. Essentially what this is you're bidding for a government contract without really knowing your competitors. You're putting all your best foot forward, hoping to win. And because you don't know who your competitors are or what else you can bid for, it encourages contractors to put their best foot forward so that they can win the award. For cost-based, we have something called sole source. Essentially what this is when there's a government contractor that is the only one who's capable of providing the services or the goods. With sole source, the government, they always want to make sure that they're paying a reasonable amount, that they're not being gouged with all these high prices from government contractors. And that's always the fear. And so, if you're, let's say, a monopoly, so to speak, and you're the only one who can provide it, the government is still going to make sure that you're charging a reasonable price. And so that's one of the things that they'll look for. Sole source can also be a timing aspect to it, where maybe there's 5 different vendors that can provide this good, but only one vendor can provide it within the time requirement. And so when I think of sole source, I think of wars, right? It's very time sensitive, or let's say natural disasters. Maybe you're the only vendor that can provide all this military equipment or bulletproof vests or so forth for a war or so forth. So there's timing aspect that's important. So yeah, there's for sole source, for you want to make sure, hey, let's charge the government a reasonable price, because that's protecting the taxpayers, right? So for pricing method, drives accounting needs. So depending on what the method is, whether it's a market-based competitive price or cost justified price, it's going to determine what kind of regulations that you'll need to follow. And so here for market-based price, think of like the restaurant industry, right? The market determines the price because there's a lot of competition there. And so if you're a restaurant that sells hamburgers and all your competitors are selling it for a lot less, then the probability of the other customers going to your restaurant goes down, unless there's a way to distinguish yourself. But in general, market-based price field, the market determines the price. For the competitively priced market, these are areas where Okay, maybe the market doesn't determine the price, but your other competitors are, right? So I think of like car dealerships, right? The more, you have different types of car dealerships, making different cars, that's going to dictate, what the pricing is. So if you're selling an EV vehicle and you look at your competitor who's selling something that's the same model but a lot cheaper, you might lower your price because your competitor has it at a certain price. And then for the cost justified price, where going back to like research and development things where you can't really determine how much it's going to cost, you just have a general idea. That's where you're going to need some of these different FAR requirements, whether it's 12, 13, 14, or 15, and so forth. So for cost type requirements for your accounting system, I mentioned, this is for your cost reimbursable contracts, but, there might be a requirement if you have just firm fixed price contracts. And so if you have a firm fixed price contract where a cost analysis is performed, there might be some accounting system requirements for you to show and how that cost analysis was performed and was done so correctly. Because at the end of the day, what is the biggest requirement or biggest risk that the government is thinking about? Well, were they charged a fair dollar amount? Other accounting requirements would be FAR Part 31. So what is FAR Part 31? Well, for those who are in government contracting, that's what you're probably used to seeing, or have some kind of idea of what it is. It's making sure that cost is reasonable and allowable. You have different types of terms, which we'll get into detail later, but whether it follows GAAP or CAS accounting standards, whether it's allowable by following the regulation, whether it's reasonable and allocable and so forth. And so there is all these different types of requirements. And then you got FAR Part 31.205, which is selected cost. And we'll get into detail later, but essentially there's all different types of expenses that the government addresses. And some of these costs are expressly unallowable. Some of the cost is allowable, but you need certain documentation to support it. And some other costs may be unallowable in certain situations. So, it talks about the black and white and the gray area of, a lot of different types of costs. And then for time and materials, what's needed for T&M contracts? Well, you need to track the time. For accounting system, one of the main areas that government auditors like to look at is your labor. Because labor typically for government contracting is your highest expense, unless you're a manufacturer. But a lot of government contractors are service providers, and so labor is going to be a big portion. Therefore, time, especially within T&M contracts, will be scrutinized. And for the materials, you want to make sure that you're charging exact amounts, and also you're calculating your indirect rates appropriately. So there's different types of requirements depending on the contract type, and so it's always important to know what contract types you have and what's applicable. So bringing the accounting needs with all the different regulation requirements. We got 52.216-7. Allowable cost and payment. And so this is a FAR clause that you'll typically see in cost reimbursable contracts. Essentially what this is it's stating that you, the government contractor, will need to provide indirect rates 6 months after your fiscal year end. For a lot of government contractors, they follow a calendar year. That means June 30th is the due date for your indirect rate submission. There are times when, let's say, for whatever reason, you can't meet the deadline. In my experience, dealing with auditors and helping clients, that deadline isn't really a strict deadline. What I suggest to clients is, hey, let your contracting officer know ahead of time. Don't ask at the last minute for an extension. Just let them know, hey, we changed, accounting systems, or we've gone through some turnover. We're not going to be able to meet, the deadline. Can we get an extension? And so it's better to be proactive in asking for that extension than asking at the last minute, because now it seems like you were just delayed, and you weren't being prudent on the timing and finishing of the indirect rates. We have this other clause 52.230, which is your cost accounting standards. So this only applies to a select number of contractors. And so if you have a CAS covered award, this will apply to those specific contracts. And so big misconception with the CAS is that it applies to government contractors. That is not the case. CAS applies to government contracts, not the contractors. And so, the last few companies I worked for, they were large government contractors, and not all their awards were CAS covered, which is a good thing. And so, whenever you have, let's say, whenever you're not following the CAS, then only those that are CAS covered will be impacted. So, there's a dollar threshold, which we'll get into, and there's been some updates and so forth. And then there is a bunch of other clauses here that may or may not be in your government contracts. And so that's just something to look out for. Another one I want to highlight here is the last one, 52.249, termination clauses. And so there's two types of terminations. One is a lot better than the other. The first one is termination for convenience. So what this states is, hey, the government, they bid an award, let's say it's a 5-year award, and they realize, hey, we don't need this service or good anymore. They have the ability to back out of it. And so termination for convenience, we help different clients go through the process and try to recover the costs that they've lost because of that termination. The other type of termination would be termination for default. And so this is something you don't want to have as a government contractor. Essentially what it's stating is, hey, you, the government contractor, cannot provide the good or services to what was agreed upon to the satisfactory level that is needed. And so essentially they're saying, hey, you really can't provide what you said you would provide. And so this is like a scarlet letter, like a black eye, it's going to impact your reputation. The more termination for defaults you have, the harder it probably will be to win new awards in the future. And with termination for default, you might also be on the hook to make sure that those goods or services that you still haven't provided are going to be taken care of, right? So you might be paying other service providers or goods to make sure it's completed. Good example for going back to termination for convenience, would be in times of war. You have all these different needs, but once the war ends, which typically war, it's hard to pinpoint exactly when it's going to end. They may no longer need those goods or services. Whether you were sending, let's say, food to feed the soldiers abroad, or clothes, uniforms, and so forth. So those are just some of the things that some of the situations that terminations for convenience may be used. Okay, so cost requirements, right? This is for procurement, FAR Part 15. What are some of the obligations when you're dealing with trying to win an award with the government? So FAR Part 15. There's going to be a format and methodology for proposing costs. And so for those who have experience in this, usually, the government is going to provide you some kind of spreadsheet to, fill in the blanks. There's also potentially a requirement to submit cost or pricing data. And so, The government, they're not just going to necessarily take your award if it's going to cost X amount of dollars. They want some backup. They want to see some vendor quotes and other things where how did you really come up with this estimate for the cost? And then we have another, the government has another tool called TINA, Truth in Negotiations Act. Essentially, you're certifying as a government contractor that your information is complete, accurate, and current. So those are just, and with TINA, there's a threshold to it. The threshold is, any awards that's over 2 million. If you account for inflation, that's 2.5 million since October of 2025. So any awards that are, 2.5 million or above, you would need to, certify your cost. And then we'll get into detail of, what that new threshold will be by the end of this year, or not the end of this year, by the end of June of this year. That threshold is going to go up dramatically. Essentially, the government, they want to make things easier for government contractors to, to do business with the government. And so, the administration, what they're essentially trying to do is, lessen the, red tape and all the other regulations so that it encourages more, competition. And if there's more competition, typically that means, better value for the government and so forth. And so, this is one of the areas that is focused on is just increasing that threshold so the burden is decreases. There are penalties for not following compliance obligations, and so you just want to make sure that you're the government contractor, you follow it because it'll definitely potentially into your profit margins, whether there's cost disallowance and other issues. So for what is the cost burden? Well, how does the government really pay for these awards, right? It's through the taxpayer dollars. And the government, their main responsibility is to make sure that fraud, waste, and abuse is not prevalent, right? As the #1 employer in the world, you're gonna, as we all know, they spend a lot of money, and it's a lot of times it's going to be hard to really keep track. That's why the current administration, they had a big focus on making sure that the government was efficient with their resources, and they created Doge. Forget what it stands for, but as we all know, how that turned out, right? They were thinking, hey, we're gonna find a lot of fraud, waste, and abuse. At the end of the day, they found some, but not really much as they initially planned. And that's because the government, they already have all these regulations put in place so that the government contractors, they don't really have too many opportunities to defraud the government. And so there's all these contract clauses, TINA, as we mentioned before, regulations, penalties for unallowable of cost, CAS. There's all these barriers that protects the government. So at the end of the day, I'm not saying there aren't any fraud, waste, and abuse. There are. I mean, given how many dollars we're talking about, and if there are fraud, waste, and abuse that is found, there could be monetary and criminal penalties. And so, to my knowledge, there aren't too many criminal penalties. When you're signing your indirect rates, in one of the schedules, Schedule M, this is where an executive, typically executive level, is signing and certifying, hey, our indirect rates just have allowable costs and so forth. And so I don't think I've heard any stories where they deliberately knew that they were doing their indirect rates fraudulently, but there's always a possibility of having criminal penalties. And speaking of that, how does the government make sure that things are running as they should, right? It's one thing to have all these regulations. It's another thing to enforce it. So we have different players. So we have what we call contracting officers, and there is there's a few different selections of contracting officers. You got your procurement, administrative, and termination. And so the PCO are the contracting officers you'll deal with when you're bidding for a contract. And so, that's the first line. And let's say you've won the award, you're fortunate to win, and now you need to perform on it. Well, now you have, the administrative, the ACO that you'll be dealing with. And so, if you have any questions, if you, let's say, or if you want to, request for additional funding or so forth, your ACO is person in contact. But let's say you're in a situation where your contract was terminated, and typically this is for termination for convenience. You're going to be talking to your TCO. And so, with termination for convenience, there's ways to recover costs, so you're not, put into that burden. And so, there's different ways to calculate your costs, your indirect costs, your direct costs, and so forth. Within, different departments, you're going to have different things. For Department of Defense, which, most of my clients are with, your PCO is going to be the agency or service branch, and the ACO is going to be DCMA. And so, DCMA, they're the ones who, they don't do the audit themselves, but they will, receive the, audit findings from DCAA, the auditors, and they'll make the decision, whether to, agree with DCA's, standing, their findings, or to, have that negotiation. So typically, if you get audited by DCAA, let's say your indirect rates are audited, and they question, cost. DCAA is the one who's going to, come up with the report. They'll give it to DCMA, and then you, the government contractor, would negotiate and talk with DCMA. But before you talk with DCMA, you will talk with DCAA with their findings. And so, it's better to, hash out differences with DCAA, so that when it comes to DCMA, it's a lot easier to discuss. And in my experience, DCMA, more often than not, will agree with DCA's findings. And so it's, sometimes it's going to be, hard to, argue for your side. And if for whatever reason you can't come to an agreement, DCMA, they rubber stamp DCA's findings, and you're like, whoa, this is not right. Then potentially you could go to court and have a case law. And typically, most government contractors, they want to avoid going to court because litigation is not cheap, right? It's very expensive to hire lawyers. But the good thing with court cases is not for the contractor themselves, but for other contractors. And so typically, it goes in court if it's in the gray area, right? DC and DCMA, they see it one way, with how the regulation's set up, and you, the government contractor, see it as a different way. And then you go to court, and the court gives its findings, and then you can use that moving forward. Anybody can use that as an argument to defend their costs in the future, right? So if the court agrees with the contractor because of X, Y, and Z, then that provides additional ammo for government contractors when they have similar situations. A lot of court cases that I've seen are related to labor. As mentioned, labor is such a large portion of cost, and DCA, they love questioning costs based off reasonableness because it's very subjective. And a lot of times they would question executive salaries, because executives are the ones who are going to be making the most within the company, and they'll question the reasonableness of it. Long story short, a lot of the case laws that happen with labor, essentially, is a lot of them sided with government contractor, where DCA, they're rigid in how they view reasonableness for salary. What they do is they'll take a salary survey to get the market price or market salary for each position, and they'll add 10% on top of it. So let's say the market price for a CEO of a certain size, industry, and location is 300,000, they'll put 10% on top, and anything above 330,000, they would deem it as unreasonable. But in the past court cases, DCA uses the 50th percentile. So court found, hey, there are some situations where you might need to use 75th percentile for the salary surveys, because maybe the company is doing really well, like the CEO has a great reputation for the company, increasing revenue and so forth, right? There's a lot of things that's going well for the company that dictates a higher compensation. Or they might have different certifications, like a PhD, a master's, maybe different type of clearance, or CPA, MBA, and so forth, where it dictates that yes, these individuals should get paid on the higher end of the spectrum. And so, long story short, when there is an agreement, you're going to go to court, and it's always important to be up to date with these court cases, because it could potentially help you, the government contractor, when you're defending how you do things. And so we got we talked about the auditors, and then DCMA, the ones you negotiate with, and then now we're talking about audit oversight. And so audit oversight, as mentioned, DCAA, they're the ones who are going to be looking at your books, your documents, your data, right? So, it can get quite invasive of, where they typically will sample costs, right? They might look into specific areas that's high risk. Those areas would be like travel, because there's so many regulations and requirements and documentation you'll need. For example, like flights. Flights, you'll need to get the lowest airfare. There are some exceptions to flights where, let's say there's circuitous routing. Maybe you have a medical need, for you need more, space for your seats. Or maybe it's not within, core business hours. Obviously it's going to cost less for a red-eye flight than, a flight in the middle of the day, and so forth. And so if you don't have those documentations explaining why you didn't select the lowest airfare, they can potentially question, some of the flight's cost. And so, that's one of the burdens of government contracting, is not only do you need to follow the regulations, you also need to prove that you're following the regulations. And so, one of the sayings is trash in, trash out. So, for government contractors, you want to make sure that you're not putting trash in, because if you ever get audited, it's not going to look good, right? Also, another thing with my audit experience is you don't necessarily need to provide the exact sample that they're looking for. So when I was working for a large government contractor, the auditors were looking at time and material contracts. And so for time and material, for these labor categories, there are certain requirements that you need to charge that, that specific labor category, whether it's years of experience, level of education, any other certifications, and so forth. And so being a large company, they asked for the resumes of those individuals that were working. And some of these individuals were working at the company since the beginning, since they've started their job, their career. And so we didn't have the latest and greatest, right? So maybe an individual who worked 13 years at the company, we just had their resume from when they first applied. And so, if the job labor category requires 10 years of work experience, obviously, that entry-level resume wouldn't fulfill or show that they're compliant. So they would question, the cost that we build at that specific labor category. And so for being a large company, people come in and out. And so for those that, were no longer at the company, what we did is we went to their LinkedIn profile and provided screenshots of, hey, this person does show that, they've worked X amount of years, and they, fulfilled the requirements for labor category. And so, alternative documentation may, depending on who the auditor is and depending on what type of alternative documentation that you provide, may or may not work, but it doesn't hurt. try and communicate with the auditors. And so, fortunately in this situation, it did work. And then from that experience, what we've learned is, hey, we need to have updated resumes from all employees, because we don't want to be in a situation where we're doing this again. So whenever you're getting audited, there's also some things that you may learn of best practices to avoid certain situations in the future. So there's always going to be the audit oversight, and I guess with the current state for DCAA, back then, DCAA, they were delayed in the indirect rate audits. It would be common to see auditors trying to audit, indirect rates that were 5 years ago. Congress said, hey, what's going on? So they, told DCAA to catch up. So they did. And now DCAA, now that they're caught up with their indirect rate audits, they're looking into different areas, right? One being, business systems, as there's 6 different business systems. And accounting system is a main focus for them, because an accounting system, it's every contractor has an accounting system. Not all government contractors have the other 5 business systems, but every government contractor should have an accounting system. So that's an area that they focused on, and also other things that they're doing are like floor checks and so forth. And so there's a wide range of things that auditors can look at. Biggest takeaway from this is, you want to be proactive as a government contractor. You want to make sure that you're well prepared. So just go under assumption that, hey, we're going to be audited. We want to make sure we have all the necessary documentation and the requirements, for the cost that you incur and charge to the government. So now going to accounting system, what are the requirements? Well, when people think of accounting system, they're just thinking of the software, right? You have these well-known government accounting systems, such as like CostPoint, Deltek, Uninet, to name a few. Does that mean that you're going to be compliant with their accounting system? No. I have a lot of different clients who use QuickBooks. QuickBooks, it's your very basic software, but you can be compliant with QuickBooks. And so it doesn't matter about what software you're using. It's a matter about how you set it up and how you use it. So, you could pay for the Lamborghini and have it, set up improperly where, things aren't going to reconcile to one another. Then it's not going to be, a good accounting system. So there's 2 ends with it. What are some of the requirements? Well, you want to, make sure that you can track your costs appropriately. You can make cost estimates that are accurate and so forth, because for these cost estimates, you're using it when you're bidding for contracts. If your cost estimates aren't accurate, then you're potentially saying, hey, what we're bidding for, contract A, B, and C may potentially be more than what it really should be. So if you want to, have cost reimbursable contracts, there's something called the pre-award survey, SF 1408. And so the government, essentially, they want you, the government contractor, to show that you're capable of, having your accounting system set up properly. So as mentioned before, cost reimbursable contracts, that's not your, typical commercial type of contract. It's unique to government contracting. And so, a lot of companies who, are commercial, companies, they might not structure their, accounting system to track it based off cost. And so, what are the requirements within the pre-award survey? There's a few things to cover here. One is, in general, it's GAAP compliant. And, everything reconciles within your GL, your trial balance, and so forth, your PSRs. In general, the FAR and the CAS, they follow GAAP for the most part. And so, if you follow GAAP with your cost accounting, that's a great place to start. Another thing with, pre-award survey is they're going to look into your labor cost. And so they're going to look into your labor distribution. What is a labor distribution? Well, it's taking, two different sources of information. It's taking your payroll register, how much you're paying the employees, and your timesheet, right? So it's going to calculate how much labor costs should go into different, cost objectives, whether it's contract A, B, and C, or maybe it might be some indirect, maybe G&A overhead labor, or I might go to B&P or I&D labor. So essentially, a labor distribution is calculating how much of those salaries should go into each bucket. And then for pre-award surveys, you definitely want to have project and job cost segregation, right? So it's one thing to segregate costs from direct and indirect. It's another thing to segregate it, amongst your projects, right? So if you have, let's say, 20 different contracts with the government, you want to properly segregate, all the costs that goes into each contract. You can't just put it into project one because you just feel like it, right? You have to put it according to which project was incurred. And so some of that segregation is also through your indirect rates. And so what is an indirect rate? Well, an indirect rate is a calculation of how much cost you can't directly bill to a project, right? Definition of direct and indirect is direct is one final cost objective. Indirect is two or more final cost objectives. Direct cost could be, let's say, labor. Hey, I spent 4 hours on project A, therefore 4 hours of my time should go to project A. Indirect would be, a good example would be like HR, IT, facility, expense. And these are all expenses, overhead that you don't know exactly how much should go into project A versus project C. It's it's benefiting the company as a whole, and so you create these indirect rates to calculate, okay, how much of these indirect costs we can charge to each project. And in theory, if you have all cost reimbursable work and you have no unallowable expenses, your indirect rates essentially will recover all your direct and indirect, so you'll be made whole, right? So if you recover that at the full amount, not including profit, you're gonna not have a profit or a loss. For your indirect rates, those are required to be submitted every year if you have the cost allowable FAR clause that we discussed about. And typically, your indirect rates can be structured using the ICE model, which is provided by the government, and that's typically the standard that auditors are used to seeing. For the ICE model, there can be some variations. For example, let's say you have 15 service centers, which have quite a few clients who might have 15 service centers, which the ICE model doesn't really account for, or other things. And so you don't necessarily need to use the ICE model to the exact formatting, but in general, the ICE model provides all the necessary document details for each schedule. Okay. So, you want to have an adequate accounting system, especially for cost reimbursable work, because why? You're being reimbursed for the cost. And so if you can't track it properly, then you're going to charge the government an incorrect amount. But let's say you only have firm fixed price contracts, then that's not going to be as useful, right? So the risk is on the government for cost reimbursable work. So you want to make sure your accounting system can track the costs appropriately. If for whatever reason there needs to be unique situations, maybe you're not following GAAP or certain other things, document and provide a reason why, so that if you ever get audited, you can provide that context to the auditors of, oh, we're not following GAAP because of X, Y, and Z. But those situations should be slim, should be uncommon. They shouldn't be common. So some of the things to think about for your accounting system. And so here's an illustration of what an adequate accounting system is. And so you start with the software, right? Let's say you go to the most basic, QuickBooks. within QuickBooks, well, there's a few things that you need to do is you need to create your procedures and processes, right? Of how you're going to do your accounting, how you're going to track your cost. On the other side, your internal controls, training, and timely reporting, that's more of how you set up your accounting system. And so, you definitely want to make sure you have good internal controls because the pre-award survey, SF-1408, a lot of it is looking at internal controls. And how do you show internal controls? It's through your policy and procedures. And so you want to make sure you have updated policy and procedures. And whenever you update them, you want to make sure those who need to know. So that's through the training. And you want to make sure that not only do you set it up correctly, but you're incurring it correctly. And so all the employees who need to know are in the know. And then also timely reporting is a good criteria for accounting system because if you don't do things on a timely manner, when I say timely manner, I'm saying like on a monthly basis, and you have issues, well, those issues won't be caught right away, and it'll be harder to fix because you're doing everything on a quarterly basis. Now you have to look at 3 months worth of data rather than 1 month. And so these are just some of the things, gives a good illustration of what's in that adequate accounting system. So key takeaway here for accounting systems is, well, your accounting system is going to be unique to you. Whether you set up your indirect rates a certain method way. Other companies, may set it up with 2 fringe rates because they might have, a large portion of full-time and part-time, and they have, different employee benefits because of that. So, key takeaway here, everything's going to be unique to you, the government contractor. And so there's no, cookie cutter way of doing things. It's, whatever makes most sense. And for your accounting system as well. Okay, so FAR Part 31. So, go over the basics. What is the purpose of this? Well, it's to make sure that, the pricing of contracts, subcontracts, and any mods is, done appropriately whenever there is a cost analysis, right? Now we're getting to the cost reimbursable side. So if it's price analysis, then it doesn't really matter if it's for a fixed price. If it's cost analysis, the risk is on the government. And so, there's a determination of what's allowable and what's not. And so with this, there's criteria of allocating costs. Is the cost allocable? That's one of the requirements. If the cost isn't allocable, then the government shouldn't be receiving some of that cost. A good example would be DCA found a company, a large government contractor, that were allocating some of their commercial costs onto the federal projects, even though that commercial cost had no benefit to the federal contracts. And so essentially that government contractor was overcharging the government. And so you want to make sure, hey, are you properly allocating your costs? Is the cost allowable? If it's not allowable, you need to treat it as unallowable cost. For unallowable cost, there is a proper way of showing that within your indirect rates. The misconception of unallowable cost is, oh, it's unallowable, I'm not going to put it in my indirect rates. That may not necessarily be the right way of doing things. Unallowable cost does not dictate whether a cost is direct or indirect. That's also another issue that I've seen with a lot of clients. They'll have, direct travel because that travel was specific to that one project, but that project doesn't have any funding for travel costs. And their mind is, oh, travel is allowable, but we can't charge it directly to the project. So we're going to move it to indirect and put it into our indirect rates. That's not, that's not the correct methodology. The thing about unallowable cost is it can also impact your indirect rates. So if it's unallowable fringe, unallowable overhead, it will definitely impact your indirect rates. The only area that won't impact your indirect rates is if it's in the G&A pool. If it goes in your G&A pool, it doesn't impact any other rates. It goes in and out. And so that's the only area that there is no impact. But in general, if you have unallowable costs within your indirect rates, you want to put it in there and show it appropriately. So for what is total cost? Well, it's mainly your direct and indirect costs, right? It's then we also have cost of money. What is cost of money? It's not necessarily an expense. Cost of money is more of an opportunity cost. And then we also have credits. So government, they want to get their fair share of credits. If you're the government contractor, you're receiving a BOGO deal, right? Buy one, get one free. And you're charging the government, the regular price for those items. That's not the correct way of doing things. And so, total cost, it's also subtracting credits that you receive as a government contractor. But as mentioned before, direct and indirect. Direct is one final cost objective. Indirect, two or more final cost objective. The same dollar for the cost cannot be both direct and indirect. Because if that same dollar is both direct and indirect, in theory, you're overcharging the government because you're charging it directly. You're billing it directly to the government, plus you're indirect on top of it, so it's double counting. One thing to know about direct expenses is if it costs more to track it, then the government says, hey, it doesn't make sense for you to track the cost. You can just move it as an indirect expense because essentially it will cost the government more if it costs more to track it than the cost itself. So they put some common sense into it. They want to make things easier for you, the government contractor. Your indirect expenses, it's through your indirect rates. Common format for indirect rates is one fringe, maybe one or two overhead, and one G&A. So however you structure your indirect rates, you want to make sure you're also billing it at the same format. So if you have two overhead rates, you want to make sure you select the correct overhead rate for each project and so forth, if overhead is applicable for the cost. So, for allowability now, we're still with FAR Part 31, reasonableness, a lot of subjectivity to this. In my experience, auditors, they see things from their point of view, right? Which makes sense. Everybody sees from their own point of view and what they consider reasonableness. I've heard from auditors say, hey, we don't get coffee, we don't get bonus, we don't get snacks. Therefore, I'm going to question, all these expenses. And so reasonableness in general, it's whatever is provided through the market, right? Market value or market price. And so allocability, we went over that. Can that cost be allocable? Standards of CASB or GAAP. Terms of the contract, very important. So as going back to travel, if your contract doesn't have any funding for direct travel, then you incur travel specific for that contract. That cost is going to have to be unallowable direct. And then also the principal limitations, selected cost 31205 I mentioned. A lot of things that when auditors take a look at your documentation, they want to make sure, hey, can you provide it on a timely manner? And do you have an adequate, documentation for it? So if you have some costs that may be, typically higher than, market value, be proactive. Have that documentation of and details of why you're spending more. Maybe, this costs more because of X, Y, and Z, which, will provide a lot more value than, a different alternative. So, these are some of the things, some good protocol to have is, be proactive when you're, documenting, because you never know if, those costs would be looked at by an auditor. So for selected costs, there's a bunch of, different areas that you're going to take a look at. Some of this, it's going to be expressly unallowable. Some of it, maybe in a gray area and so forth, expressly unallowable would be like fines, penalties, entertainment, lobbying, bad debt, and so forth. Those are costs no matter what situation, you're not going to be able to recover. And then all these other things, recruitment costs, relocation, rental. Think about rental costs. So now that hybrid working is more common, auditors, they've been looking at whether your leased facilities are considered idle, right? Are you maximizing the space? And so if most of your building is no longer in use because let's say all your employees are working remotely, it makes sense for you, the government contractor, not to have that lease anymore, right? So you want to make sure that you're taking a look into into your leases as well and so forth. So there are penalties. So if you for whatever reason have all these unallowable costs in your indirect rates and you're charging it to the government for expressly unallowable, it's going to be your disallowed cost plus any interest portion. And if you know that you had unallowable costs before you submitted your indirect rates, it can be additional, right? It could be 2 times plus interest plus any other civil and criminal penalties. So it's always going to be some kind of consequence if you don't follow the rules that the government placed for government contracting. A lot of things that auditors going to question would be the audit support wasn't enough, it didn't provide enough details, documentation, and other things. So key takeaway with cost allowability is, make sure you have the documentation, make sure what type of cost you're incurring, know, the FAR clauses that's required for each contract. And so that, that's going to take a lot of effort, especially if you have hundreds and hundreds of contracts. Okay, so we're going to go over cost accounting standard, go over this quickly. So, what is cost accounting standards? Well, cost accounting standards, an additional set of regulations that, you may need to follow as a government contractor. As I mentioned before, it applies to contracts. So you can have CAS covered awards, but doesn't mean that all your awards are going to be CAS covered. There are some exemptions, and there's something called modified versus full. If you have a contract that's above the $50 million threshold, you're going to be full. Anything above 7.5 million will be modified. And if you have CAS covered awards, you'll need a disclosure statement. So there are a few exemptions, the 9 exemptions for CAS. Some of the things I will highlight here will be contracts and subcontracts with small businesses for a fixed price and fixed price with economic price adjustments based off commerciality. So essentially, what that is hey, if you're using commercial items, cost is already set, right? So there's going to be really no risk to the government of whatever price they're paying. And so, when you think of CAS, you want to think of, what is the risk to the government? And if there's less risk, then, probably there'll be less, things you'll need to look for. There are some waivers that can be applied. And so if, you have, it's less than 50 million and, primarily involved with commercial items and there's no CAS covered work, that can be an exemption. CAS board can waive any or all requirements depending on the request. And so there's ways around it with those exemptions and waivers. So here are some of the clauses. So there's all these standards here. So for, if you're modified CAS cover, you have your basic standards, which are, 401, 402, 405, and 406. And then if you're full CAS, you have all these other additional standards. Updates with CAS is that they are going to get rid of some of the standards, like 417, I believe. Basically, if it follows GAP, you don't really need these additional, standards that talks about it. But in general, as you can see here, your disclosure statement is going to be, talking about, all of these things. So, what is a disclosure statement? Well, a disclosure statement is essentially a documentation that describes how you do your accounting. And so, you have all these different parts. You have a part for direct, another part for, how you treat costs. Is it direct or indirect, or is it sometimes both? And if it is sometimes both, provide an explanation of those situations, especially your indirect or depreciation, capitalization, other cost credits, deferred comp and insurance. And for those who have home office, home office expense. So, they go over a wide range of different areas for that. So for CAS, you definitely need to, make sure you're compliant. If you're not compliant, then, there can be penalties, obviously, but then also, it's just not good, practice to have, potentially, have, take a hit to your reputation and so forth. Maybe, contracting officers, may not, trust you as much down the road. And another thing with disclosure statements is, for companies, they're always going to, revise how they do their accounting. And if you ever do update and revise, maybe you change how you depreciate some assets, maybe you go from, straight line to something else, or, or maybe a treatment of direct or indirect cost, you'll need to update your disclosure statement. And when you update it, you need to also submit that to the contracting officer, also including what we call a general dollar magnitude. And so, what is a GDM? A GDM is saying, hey, this is the impact, the cost impact of our accounting changes. And so it's a lose-lose situation where the government's always going to win. And for CAS covered contracts, if you do a GDM and your accounting updates benefits the government, where you're, charging less cost to the government's going to accept it and say thank you. On the flip side, if it's going to cost more to the government CAS covered awards, the government's going to say, well, you're going to have to pay that. So you can never, the big misconception is, you'll take some of the wins, some of the losses, and if it evens out, you owe nothing. That's not necessarily the case. They're going to take the win and you're going to pay the loss. So, whenever you make some changes, and if you have CAS covered awards, these are things you have to consider. Which is also another good reason why, if you're a contractor, CAS does not apply to your company as a whole. It applies to individual contracts. So, so let's go over TINA. The threshold before was 2 million, or if you include inflation, 2.5 million. Now they're pushing a threshold of 10 million, which is a lot higher, right? So now, certified cost or price, to make sure that your documentation is complete, accurate, and current. That requirement, as long as it's under 10 million starting, July 1st of 2026, you won't have that TINA, requirement. Another thing that CAS board is looking at is applicability of IDIQ contracts, and IDIQ contracts essentially is a contract where the government, they don't exactly know how much they're going to request for the goods or services. So they provide a bare minimum just to make it a contract, but the ceiling could be, infinite, so to speak. And typically, the funding, because the ceiling's so high, it might be like a lot more than what they would ever use it for. So they're going to talk about, okay, for IDIQ contracts, how do we treat it, right? Because a lot of these IDIQ contracts, that the ceiling of revenue amount is going to be a lot higher, so that CAS will be applied. But in reality, it might be, they might not even get close to that ceiling. So, CAS board is going to talk about that. Another thing about CAS is, to be full CAS, they're going to move it from 50 to 100 million. So, just a lot of, things that they're changing to, encourage government contractors to get into government contracting. So now we have 4 different polling questions. Number 1, when is accounting system needed for government contracting? Is it 1, for all federal prime contracts, 2, for commercial service contracts, 3, for competitive contracts, or 4, for cost reimbursable contracts?
I've got that up. I'll give you guys a moment.
Due to timing, I will make this quick. And so, yeah, it's for, number 4, for cost reimbursable contract. That's typically what you're going to need. If you have firm fixed price contracts, you don't necessarily need approved accounting system. So number 4 would be the right answer. Number 2, polling question number 2, what is an accounting system? Is it the software, the policy and procedures, the internal controls, training, or all of the above? Okay, so I think a lot of people are getting this one right. So it is number 5, all of the above, right? It's not just the software, it's also the internal controls, training, the people who are managing and putting the information in. That is correct. Polling question number 3, which of the following is not a criteria for a cost to be allowable? Cost must be reasonable, the cost must be allocable, the cost must be approved by DCAA or DCMA. Cost is not unallowed per an applicable cost principle. Sorry for the wording on this. I know it's not the best. I hate these negative questions. But for timing reasons, yes, it seems like most of you are getting it. It's number 3, the cost must be approved by DCA or DCMA. That's not necessarily the case. It doesn't have any regulation that it needs to be approved by them. DCA, what they do is they'll question the cost, but doesn't need to be approved by them. And then the last question, number 4, which of the following contracts would not be exempt from CAS? Number 1, 15 million contract for commercial services. Number 2, 25 million competitive fixed price contract where the contracting officer asks for uncertified cost or pricing data. Number 3, 15 million cost reimbursement contract to a large business. Number 4, 32 million contract to a small business. And number 5, none above. So we're going to a mix range of answers here. Answer is number 4, $32 million contract to a small business, small business being one of the 9 exemptions. Would not be, no, that is exempt. That's not the answer, sorry, misread it. Number 1, it wouldn't be because commercial services would be exempt. Number 2, it's a competitive fixed price. That's not the answer. Number 3 would be the answer, $15 million cost reimbursement contract to a large business. So that would not be exempt. So it will be modified CAS instead of the full CAS. But the answer would be number 3, sorry. But I hope everybody has enjoyed the webinar. It's great to see you and hope you have a happy New Year's. I know it's early in the year, so.
Thank you so very much, Adam. As usual, we'd love to know how we did today. All feedback is greatly appreciated. Make sure you guys check out the PCI website for our upcoming trainings. I do see 2 questions. Adam, not sure if you want to go ahead and answer those. I'll read the first one. Regarding airfare reimbursement, does the government have issues with unrestricted fares versus restricted fares? Obviously, restricted fares have lower costs.
It really depends on, the auditor. And so, if you can provide, explanation of why you go with, restricted or unrestricted, then in general, you want to choose the lowest. I know with airfare, there's a context to it as well, right? Let's say you need and you book your flight, 1 day in advance. Typically, flights are going to cost more, but as long as you can show you're choosing the lowest airfare, even though typically that might be higher than normal cost. So, whenever you choose a flight and it costs more than it would usually would, just provide some kind of documentation to it. And, the auditor, when they review it, they'll, give their assessment whether they agree or not.
Thanks, Adam. And we have one more question. Has the modified CAS coverage threshold also been raised, or only the full CAS coverage to 100 million?
I, that's a great question. I have to take a look at that. I not exactly sure at the moment, but yeah. So I haven't seen anything with the modified, but it doesn't mean that there hasn't been anything. And so I have to take a look at that. Yeah.
Alrighty, that wraps us up. Thank you so very much, Adam, and thank you all for joining us today. Again, make sure you check out the PCI website. We have a lot of great things coming up this year, and I wish you all a happy new year. See you all again soon.
Thank you.